All right, everyone, we are going to kick this thing off. First and foremost, I'd like to say hello and thank you to everyone so much for joining in on this call this morning, especially since we know it was such short notice. However, we will be doing additional calls in November and December to discuss qualified plans. So if there is something that you feel that you may have missed or you want another opportunity to listen on, certainly you will get that opportunity again. We think you will find this call to be very helpful, informative, and a good addition to your business offering out to your clients. We will be fielding questions as it relates to this presentation. Please feel free to type your questions into the chat window, and towards the end of the call, we will go through your questions and provide answers, and if necessary, open up the floor for a verbal discussion. So Stephen Toth of National Pension Associates will be your host for today. He and his daughter Danielle Toth are both very well versed in using life insurance within qualified plans, and Steve has had his practice doing this very type of planning for 22 plus years. So without further ado, I present to you Steve Toth of National Pension Associates. Steve, take it away.
Good morning, everyone, and thank you, Ashley. I appreciate the opportunity to visit with you all this morning. Hopefully, you're going to find this informative, educational, and open up opportunities that you may be bypassing for some of the bigger cases that are out there that we do all the time. What I'm going to do is walk you through the PowerPoint slides, but as I'm moving forward through this, feel free to ask any questions or type in your questions and we'll discuss them all. The reason why we do these is because most small businesses don't have a tax-deductible retirement plan. In fact, a number of years ago, we did a survey along the I-4 corridor in Florida, that's from Daytona Beach to Tampa, and at that time, we determined there were only 15% of all the businesses had any kind of a qualified plan. So we know that there's a need out there. What are some of the reasons why they don't have the plans? Well, one of them is many of the owners don't think they're going to get a large enough share of the plan contribution because what they've seen are simples and SEPs and maybe a profit sharing plan or a 401k plan. But what we want to do is show them ways to get much larger contributions. Owners also think administration is going to be too costly and too much paperwork. Matter of fact, it's really not that complicated. I mean, basically, we send out a census at the end of the year. They complete it, so it shows us who they've hired and who they've let go, what their salaries have been. And from that, we do the valuations, the participant statements, and everything else that needs to be done. Owners don't know where to go for advice or how to begin the planning process. The reason why I work with CPAs so often, and I have done literally hundreds of CPE seminars throughout the United States, and they are the best source of quality leads because the owners, or at least the people that are in the top tier in the CPA firms, know their clients. They know the ones that are making money. They know the ones that have been making money for a while, and they know the ones that will probably continue to make money going into the future. So we think that if you have CPAs as clients or if you have CPAs as friends, they should be somebody that you definitely want to be in touch with and help educate them to the opportunities that are available to their clients. Okay, why should a business owner sponsor a retirement plan? Well, the answer is tax deductions. Most business owners are constantly looking for tax deductions. And in this environment, in which we constantly read in news every day that there are going to be major changes to income tax and estate tax and capital gains tax, everybody is looking for more ways to get tax deductions. They want retirement benefits. Most people want to be assured that they're going to have a retirement benefit when they do retire. They want to retain and attract employees. At least most good employers want to keep the good folks, get rid of the bad ones so that their businesses prosper as they're moving forward. But probably one of the hidden or forgotten areas of opportunity for a business owner is that the money that's inside of a qualified plan is creditor protected. There's only one entity that can get their hands on a person's assets that are in a qualified plan, and if that's the IRS, and then only if you do something that's not appropriate. Okay, so let's do a quick overview of qualified retirement plans. Most retirement plans, well, all retirement plans are under IRC code, that's Internal Revenue Code section 401A, that receives tax favored treatment. Plans are tax deductible, they're tax deferred growth, and there's only two types of plans out there. There are defined benefit plans where we're going to define the amount of money that the plan participant is going to receive at retirement. And the second type that you're mostly familiar with are defined contribution plans, where we define what the contribution is that's going to go into the plan, and then whatever investments you have are going to determine how well or how big that pot of money is going to grow. So let's talk about the plan options. There, everybody's familiar with SEP plans, simplified employee pension plans. Today, I'm not going to talk about simples, but I am going to talk about the SEP. We're going to talk about profit sharing plans, 401k plans, traditional defined benefit plans, cash balance defined benefit plans, and fully insured defined benefit plans. And then something we refer to as a 412E3 carve-out plan, which is just another way to try to maximize money that's going to the highly compensated or business owners. So let's do this. Let's do a little comparison of the different kinds of a plan. We've got a small business owners, two small business owners that are each, one is 53, one is 50. They're both taking the maximum amount of considered compensation. This is what the IRS says is the maximum amount of W-2 compensation that you can take out of a business in any calendar or in this calendar year. So what I'd like you to keep in mind is that that amount goes up a little bit each year. Generally, the service will say, okay, there's going to be an increase of X percent, and then that salary can go up. And so people can get a larger contribution into their plans in future years as long as the salary cap goes up. If we were to do a SEP plan, a simplified employee pension plan, our two business owners could each get $58,000 deduction. But they'd also have to put away $13,200 for employee number one, who's 34, and $12,440 for employee number two, and as you can see, $5,200 for employee three. But instead of doing an SEP, they did just a plain vanilla profit sharing plan. The two owners could get the same $58,000, but look what happens to the contributions for the other employees. Drops down significantly to the point where the business owner still gets a tax deduction for almost $124,000 a year, which is 94%. They get to keep 94% of that tax deduction. In the SEP, they only got to keep 79% of it. So you can see right off the bat that if you had a choice between a SEP and a profit sharing plan, it might be in the business owner's best interest. Obviously, we don't have all the facts which have to be taken into consideration when you do one of these. Okay, so now let's talk about a profit sharing 401k plan. Just so that everybody knows, you can have a profit sharing plan without having a 401k plan, but you can't have a 401k plan without having a profit sharing plan. They go hand in hand. All right. So you can have a plain vanilla profit sharing plan without a 401k, but if you want a 401k, you have to have a profit sharing plan underneath it. Now, what that does, as you can see in this illustration, for our two business owners, they're now getting $64,500 each, and the contributions for the other three employees don't change, except that the employees can take advantage of salary deferral if the employer allows it to happen. This could be a safe harbor plan where they get additional incentives to put their own money into the plan, which could make it a better looking plan for them it's not going to impact the employer very much at all. So in this particular plan, designed this way, our two owners get 94% of the total contribution. All right. Just taking advantage of some of the laws that are out there. A traditional defined benefit plan is simply a plan sponsored by the employer in which he guarantees a specified benefit level at retirement. These are the plans that most of our parents had wherever they worked. Most of the major companies offered a defined benefit pension plan that paid them a specific amount of benefit at their retirement age. A lot of companies have moved away from these. Some of the largest ones still have them, but these are not the plans that we see most frequently. But it does provide the highest tax deduction for an employer, and it's completely funded by the employer. So an employee doesn't have to put any money into this plan, and they're going to get a guaranteed monthly benefit at retirement time. Each employee's future benefit, it's a calculation. We use this, typically the actuary would set up the whatever the formula was going to be. Today we have computers that do that for us, depending on what the employer wants to provide as a benefit for the employees in his company, which is a lot of times based upon what amount of a contribution they want to make will depend on what the formula is going to be. But you can always, almost always guarantee that whatever it is, the employer is going to do so that they get the largest percentage of it. At least in my almost 40 years of doing defined benefit pension plans, that's been the experience that I have had. So let's take a look. How does a defined benefit plan, what are its advantages? Well, the contributions aren't included in the employee's income for one, and that's pretty important to employees. Tax deferred growth until distribution. Benefits up to the lesser of almost $230,000 a year, or 100% of compensation, because these benefits are typically a percentage of whatever the W-2 compensation an employee takes out of the plan will depend on what the benefit is going to be. And the employer, along with us, you, me, the actuary, will determine based on how much of a contribution they're seeking. We'll design a plan based on their input, on your input, and we'll design the plan around that. Sometimes we have to design 2 or 3 plans to come up with what's satisfactory to the business owner, who's usually almost always the trustee of the plan. Okay, these benefits are guaranteed. There's no ands, ifs, or buts. If somebody comes to work for an employer that has a defined benefit pension plan and the retirement age is, say, 65 with X number of years of participation, then they're guaranteed to get the monthly benefit for the rest of their lives. Okay. So some of the benefits. These plans can offer life insurance. The employer can offer life insurance. Everybody is going to get it if the employer offers it. The only issue may be is whether they're qualified to receive it because of health or other issues. But if they do take it, they don't pay for it. The employer pays for it. Okay. All right. What are the disadvantages of a traditional defined benefit plan? Well, it's pretty inflexible for the employer. It requires mandatory contributions. Once the census is turned in at the end of the year for all the employees, new and the ones that have left, and what their W-2 compensation is, and based on what the prior year's formula was, those contributions must be made. Okay. Employer doesn't have an option. The funding is required annually. We do have to use an actuary. We keep him locked up. He's in a building on the other side of town. They're pretty bright. They're very, very talented at what they do, but we have to use them to calculate the benefits and the values of these plans. You may have to purchase pension insurance. It's called PBGC, Pension Benefit Guaranty Corporation. Depending on how many employees you have and how much they earn and what kind of benefits are, the PBGC is there to protect The rank and file employee, not so much the owners. So if a company were to fold and they had a traditional defined benefit pension plan, while the owners may suffer a loss, a significant loss in some cases, the rank and file are going to be guaranteed a certain amount of benefit provided for by the Pension Benefit Guarantee Corporation. The employer or the plan trustee pays a premium to the PBGC for that protection. So employees who do work for this company may not be aware of it, but that's going to be one of the advantages that they'll have if they are in a traditional defined benefit plan. The benefits themselves aren't portable unless it's a lump sum distribution. What I mean by that is if you've accrued a benefit of $5,000 a year and you quit the employer before retirement time, you can't take that benefit, but you can take the lump sum cash equivalent that you're vested in and roll it into an IRA or another company's pension plan, or just take it as a cash distribution and you're going to be taxed on it. Okay. So benefits are not easy to understand for many employers. Over the years, I've had to go out to many, many employers and hand out their benefit statements and answer questions from the employees so that they could understand exactly what they were receiving, because a benefit statement isn't like a bank balance. It's not like you have a bank book and here's how much cash you have. It's expressed in the amount of benefit that you have and how much of that benefit is vested. Okay, so traditional defined benefit pension plans are not the easiest plans in the whole wide world for a plan participant to understand. So they need somebody like you, somebody like an actuary, somebody like me to be able to explain it to them. Okay, let's take a look at how this plan compares to the other plans that we've shown you. The owners are still the same, the employees are still the same, but now look what happens to the total contribution and the percent going to the business owners. The two business owners end up, employee number one, or the 50-year-old, gets $112,930, but employer number two gets more. He gets $134,403. And why is that? It's because owner number two is older and has a shorter period of time until retirement time. So we need to put in more money in order for him to get the same benefit that owner number one is going to get. Owner number one has a longer period of time to fund, so therefore their benefits are going to be the same. It's just the amount that they have to contribute for themselves in their company's plan. Now, let's look at the other employees. Employee number one gets $12,500 to buy his benefit. He's 34 years old. Employee number two is 40 years old. And based on their income and their age and their years till retirement, we've determined it's going to cost $18,050 to fund the benefit this year. And employee number three, who's only 32 and only making $26,000, it's only going to cost $4,360 to fund their benefit. But the employers still get 88% of the total contribution. Okay. The thing that they're going to bark about in some cases is that 12,000 and that 18,000, unless they're relatives or they really like these people and they really don't want to do any other kind of plan that we might be able to show them. So now let's move on to a cash balance defined benefit pension plan. A cash balance plan is a hybrid defined benefit plan that combines features of both a defined contribution and a defined benefit plan. Excuse me one second. These plans are very popular. Unfortunately, right now, the IRS is taking looks at these plans to make sure that they're not abusive. Okay. Right now, we're not sure where this is going to land. These are a very popular type of plan, and we're constantly in contact with service to determine if this is another one of the witch hunts that we went through before in defined benefit plans, or if this is just a passing situation. But these plans are like a defined benefit plan in that they're funding for a benefit at retirement time. Like defined contribution plans, the benefit is shown as an account balance, although it's hypothetical. Okay. Sometimes a little challenging to understand in the fact that these account balances are hypothetical. When a contribution is determined by the actuary based on the hypothetical account, plus the investment performance of the real plan assets in the defined benefit portion, like other defined benefit plans, the employer benefits during good performance, but not during bad. Let me explain it another way. If the owner invests the money in mutual funds, stocks, bonds, real estate, limited partnerships, you name it, any kind of uh, investment that's considered prudent by the Internal Revenue Service, if those investment returns go up, then everybody's happy. If for some reason the investment return goes down, not only will the individual account balances be impacted, but it may require that the employer contribute more money in order to bring those account balances back up to what's been promised. Okay. If you combine it with the 401k plans, then you've got two plans tested as one. You've got the defined benefit plan, you've got the profit sharing 401k plan. We have to test them as if they were just one plan, and you need an actuary to be able to do this. Gets a little complicated. So the cash balance plan is set up with a large benefit to the owners and a smaller benefit to the employees. And that may be what the IRS is looking at and say, geez, guys, we don't want you to give the employer who invested all of his money, time, and effort in building this business a bigger return. But maybe that's what's going on in today's environment. And then finally, by giving the employees a benefit in the defined contribution plan, it's going to cost the employer less than if he just funded it all in the cash balance plan, like if it was just in the traditional defined benefit plan. So this is what a cash balance plan is. They're very popular where they fit, can be a wonderful plan, but I warn everybody that right now the service is taking a close look at these. What are the advantages? Well, the employees can more easily see the benefits of a cash balance plan. The benefits may be portable, but the cash certainly is. It's more flexible than a traditional defined benefit plan. The tax deduction to the employer will typically be much higher than in a defined contribution plan. And when you combine the defined benefit and defined contribution, it minimizes the contribution requirements for the employees while maximizing the benefits for the owners. And obviously that's one of the reasons why business owners like these type of plans. So what are the disadvantages? The employer is going to bear the investment risk. Once again, in typically almost all of these plans, the trustees are the owners of the plan, and they determine what the contributions are invested in. And if the investments are good, everybody's happy. If the investments are bad, that's going to be a challenge. So that may cost them to make bigger contributions to make certain that the benefits that have been promised are there. It does have an annual funding requirement. The actuary is going to determine that through an actuarial certification at the end of the year. And if we want to take a look how a cash balance plan combined with a 401k plan looks, here we go. The cash balance and the 401k give the two business owners exactly the same contribution. Now, isn't that interesting? In the traditional plan, the older owner got a bigger percentage of the contribution than the younger owner. But in a cash balance combined with a 401k plan, quite often, at least in this example, they're going to get exactly the same level of contribution, where employees 1, 2, and 3 are going to get what you see there. Now the two owners are going to get 95% of the total contribution put into the plan. And now you can see why business owners may like this type of plan. Sometimes we have to design several different types of plans, just depending upon what the objectives of the business owners are, their ability to make not only current year contributions, but we've got to talk to them about future year contributions. And that's where their CPAs come into. I always like to talk with the client's CPA to get an idea of what their earnings history has been in the past and what they're predicting the earnings are going to be in the future. That's a way you can help yourself and your client from having grief when the big contribution they got this year turns into a big challenge for the following year. All right. Again, pardon me. So let's take a look at a 412E3. Some of you may remember these as 412Is. All they are, it's the same exact plan. They just changed the code under which it falls. Used to be under section 412I in parentheses. Now it's under code section 412E3 in parentheses. The language in the code is exactly the same as it was prior to the change. So there's been no change in what these plans can do. All right. A 412E3 is a defined benefit plan that's funded solely with life insurance products, whether it be an annuity or a combination of whole life and an annuity. You can't put 100% life insurance in, but you could put in 100% annuity. Most plans are a combination of the two, something like 40-60, 30-70, 45, 30, you got it. You understand. It can't be 100% life insurance. Insurance companies are the ones who guarantee the benefits. We only work with top-rated insurance carriers so that we know that whatever benefit that the plan design came up with, the insurance company is going to be the one behind the plan that's going to guarantee the benefits to the employees, the cash values of the annuity, cash values of the life insurance, the benefits that they're projecting going to be there at age 65. Okay. These plans oftentimes offer higher deductions, and the reason for that is we're using guaranteed products. So if we have guaranteed life insurance and guaranteed annuities, we're using the guaranteed portion of the life insurance, not the projected dividends. And the same thing with the annuity. We're only using the guaranteed portion and not what the earnings are on that annuity. But what's going to happen is as we do our annual valuations, if there is a dividend off the life insurance, it's going to reduce next year's contribution. The benefit doesn't go down. The lump sum doesn't go down, just the cost to fund the benefits. Same thing with the annuity. If whatever annuity rate we used when we set the plan up, 1%, 2%, 3%, whatever that is, if the annuity company pays out a rate greater than what was guaranteed when we set the plan up, that will also be used to reduce the contribution for the following year. In the many, many years that I've been doing these plans, I've actually had plans where the dividends from the life company and the excess interest from the annuity have gotten to the point where the plan couldn't be funded any longer. So that we either had to go back in and add things to it or redesign the plan. Fortunately, because the IRS has gradually increased the amount of annual income that they could fund, they could add additional benefits each year as the uh, amount of income level the government said that we could provide benefits for goes up. So we can sometimes continue to increase the contribution at the same time these dividends and excess annuity rates are reducing our cost. All right. Just as I said, excess investment earnings reduce future contributions, can be a very positive thing. Whole life insurance can be used to help guarantee the benefits at retirement and provide a very large death benefit. It's not unusual for us to do for guys that are not real old, but let's say they're in their 30s or 40s that are making maximum income, to see, depending on the carrier, a $2 or $3 million death benefit. And the fun thing about that, you've got to understand that if somebody dies while the plan is in place, the life insurance is paid out to the named beneficiary, less the cash surrender value is paid out income tax free. Whoa, we got a tax deduction when we funded the puppy. It was tax deferred while it was growing. And we have the possibility of getting that part of the death benefit paid out to our beneficiary income tax free. That's a pretty doggone positive sales point that you want to understand completely when you're selling these things or explaining these things to the person buying it or their advisors. Okay. So what are the advantages? Well, it's going to give you the maximum current tax deduction. There's absolutely no market risk. The accrued benefits are equal to the contract value. ERISA creditor protected. Once again, as long as you don't do anything to try to evade your taxes, the IRS can't get their money on this, nor can anybody else. You could go bankrupt. Hey, look, I use this because O.J. Simpson, who has had a checkered past to say the least, continued to collect his $25,000 a year or month, I think it was, benefit from the NFL, even while he was in prison. Okay. That's one of the things that people really like. And that's why these type of plans are very popular with the folks that have the kind of cash flow that can fund a plan of this type. The insurance company is the guarantor of all of these benefits, the cash value and the monthly benefit, if that's what they want. We don't have to put in the pension benefit guarantee corporation variable premium in this type of plan. Why? Because the insurance company guarantees all of the plan participants the benefits or the cash value of the plan. So let's take a look. What are the advantages? Typically, if the business owner is looking for higher contributions, this is the plan for them, but it does require annual contributions and it's very inflexible. Once you set one of these plans up, pretty much plan on keeping it for 5 years unless, there's some really drastic thing. There's always a back door to the Alamo. Okay. But these plans are considered to be retirement plans. And as such, the watershed number of years, generally speaking, is 5 years or until normal retirement age. But if bad things happen, the business goes defunct, the owners die, they become disabled, the company gets bought out for some reason, then there's opportunities to negotiate a much reduced type plan or even termination of the plan and paying out the benefits to the plan participants. So these are not a plan that you want to start off and make a $500,000 contribution this year thinking that you can put in $250,000 next year. You'd have to have a pretty good story to tell the IRS to be able to do that. Okay. So let's see what a 412E3 does for plan comparisons. Our business owner number one is going to get over $300,000 contribution. Our little bit older is going to get 380, almost 383,000 of contribution. Now we do have to put in some bigger bucks for employees 1, 2, and 3, but they're still getting out of a $779,000 contribution. The two owners are still getting 88% of the total contribution. Not bad. I don't know about you, but I think 88% is pretty darn good. The last one we're going to look at, and I have to tell you right up front that these are being looked at by the Internal Revenue Service. It's a combination of a 412E3 defined benefit plan and a defined contribution tested so that the owners receive the majority of the contributions. It may work well when you have a traditional or cash balance plan, does not generate the contribution desired. Okay, these will generate the largest contributions for the owners if they're making the kind of money and if they can afford to maintain a higher annual contribution, because they got to make it. Okay, if they get into a pickle where next year we started putting in 400,000 or 500,000 this year and next year cash flow won't allow them to do it, boy, oh boy, it's going to really take some doing to dismantle the plan Okay, roll over the money into probably another kind of a plan, or maybe terminate the plan and distribute the funds into folks' IRAs. So keep in mind, this type of plan is really only for those business owners or professionals, the successful ones that have both the desire and the ability to fund for at least a 5-year period of time. Okay, that'd be my general rule of thumb, 5 years. Bad things happen to good people, and if it's less than 5 years and there's a justifiable reason, yes, we can apply to the service for termination and make the adjustments that we have to make. But keep in mind that we should be looking for prospects that have steady annual revenue, can afford to write the big checks at the end of the year, and are committed to doing it for at least a 5-year period of time. All right. Let's see. What are the advantages? Well, it's the biggest maximum tax deduction with no market risk, and the accrued benefit is equal to whatever the contract value of the life insurance and the annuity are together. Okay. These are ERISA creditor protected. I don't care who you owe, what you owe, unless you committed fraud. These are creditor protected. Nobody can get their hands on these dollars, except, of course, the IRS if you do something wrong. The guarantees are provided by the insurance company, and both the cash value, the death benefit, and the income that's in the plan. All right. And again, there's no PBGC, and there are a lot less reporting requirements for these type of plans. So if we do a plan comparison, oh my goodness, look here. Our two business owners aren't going to get any more money. They're just going to getting a bigger percentage of the total money. Now they're getting a deduction of about $700,000, but they get 98% of it going into their two pockets, where everybody else is going to split the other couple of percent. And that's where we may be running into some trouble with the IRS. Some of the folks may not think that's fair. We're, we're still looking at them. We're still talking to the IRS. We're still trying to get from them what they are willing to do and what they're not willing to do. But these are plans that we've been doing for a very long time. So we're hoping they'll win the day. So work with us. We'll help you. Um, the disadvantages here are the higher annual contributions, perhaps uh, for the plan participants. Um, these plans require the annual contributions, and they're very inflexible. Are there opportunities? Yeah, 72% of small businesses, successful small businesses, don't have any type of retirement plan. Only over a third of the owners aren't saving enough for their retirement. And the expectation for the owner is they want a preferred retirement age. They'd rather retire at 62 if they could. Okay. We have people that don't start these plans until age 70 and are going to have an age 75 or later retirement date. I'm working on several of them right now where they're already in their 70s, and we're designing plans for them to retire at 5 years down the road. So don't look past the fact that if you're dealing with people who make a lot of money and are looking for tax relief, don't be afraid to send in a census or request a census. And that's the other thing that we want to tell you. Working through Fortress Brokerage, all you have to do is get a census, and we'll design a case. There's no cost for the design. I'll work with you. Danielle will work with you. We'll work with your client. We'll work with your client's CPA, the attorney almost never, uh, but the CPAs quite often, and maybe any other advisors that want to be involved. But the real one is the business owners themselves. A lot of times the producers like us to be on the phone with them, explain how these plans work, the pros and the cons, and assure them that we know what we're doing. And we want to thank you for your time. Now, there were a number of questions. Ashley.
I have not had a question yet come in the chat window.
Okay. Well, Do you want to open it up and let anybody ask a question if they want to?
Yes, I think that would be a wonderful idea. Let me go ahead and do that right now. Oh, we did just get a one question in the chat window. Are there any plans for business owners that get K1 income?
Well, yeah, if all they get is K1, they can't take advantage of any kind of a qualified plan. But usually what we do with those folks is if they're in the situation, we will show them if they convert some of that K1 to W-2 income, what it's going to cost them is the FICA and FUTA that they have to pay as a W-2 person. Okay. But if the tax deduction is much greater than the cost of the additional FICA taxes they're going to have to pay, it may well be worth their time. So just because somebody takes a K1 doesn't mean that they can't convert that to W-2 income. A lot of times it depends on the type of business that they have. If you're just an individual that's getting K1 from an investment that you made, unless you wanted to go through the trouble of setting up a business and declaring a W-2 and taking and paying the taxes on that and taking a W-2 income, I'm not sure that it would be advantageous. But we help business owners all the time, especially those that take significant K1 distributions, how to convert some of that into W-2 compensation, build a plan around that number, and get them huge tax deductions. And the weight of the tax deduction and the benefits of the tax deferral, the creditor protection, potentially the death benefit to their loved ones, far outweighs the cost of having to pay some FICA and FUTA.
Thanks, Steve. We did get another question. It says, explain more about the IRS scrutiny and chance of winning. Are cash balance plans receiving less IRS scrutiny?
It depends on the plan design. Okay. It really depends on the cash design. In fact, as we speak, I have got questionnaires out to a number of TPAs and a number of insurance companies that support cash balance plans, and I'm looking for some feedback. So right now, today, I would say it's a little bit up in the air. And as soon as I know something, I'm going to make certain the world knows something, because it's vital to my practice. It may be vital to your practices as well. So this is one of those questions we just don't know what the service is about to do. The problem, and I don't want to be political, but the problem is that we have a government that wants revenue, and they're looking to do everything they possibly can to generate more revenue. Do they have cash balance in their sites? Don't know. But it's a supposition that they're trying to look for every little thing that they can come up with that will generate them more revenue. So we'll let you know when we know.
All right, Steve, we got another one here.
Yeah.
What do you do if you have an owner that is uninsurable with a 412(e)(3) plan? Do you just fund one with 100% annuity?
Yep, that's what you have to do. Okay. And then you just, you try to find the best annuity you can. If you're with a specific carrier, as long as they have an annuity that's been approved for inclusion in a 412I, both the carrier and the state that you're in, then sure. Well, I've done a lot of annuity only plans, but we just want to make certain that the guy is uninsurable, because there's always somebody out there that may take a crack at them. And then it just depends on whether the rating, if there is a possibility of a rating, is worth it, because that rating is also deductible. Okay. So sometimes you just have to do the math to determine it. But we've run into uninsurables. We've run into rated folks. We've run into people who just don't like life insurance, annuity only, and it gets you where you got to go. Just won't get you as big a deduction. Okay.
All right, and we have another question here. Can you please explain again how our folks should work with National Pension Associates? How would you like to do introductions, coordinate efforts, and whether or not there is fee sharing?
Yes, yes, there is. There's no fee sharing on the fee to set up a plan. That's just a fixed number. I think I've provided the National Pension Associates fee schedule. And if I didn't, I'm more than happy to do that. There is a commission split. It's a 70-30 percent split. 70% goes to the producer or producers, and the 30% comes back to Fortress Brokerage and National Pension Associates.
A couple more here, Steve.
Sure.
Have you used death benefit to fund buy sell with partner?
Yeah, you can do that. It just depends on the plan design, but we have done those kind of plans in the past. Typically, what we've got to make certain that we do is that there is the buyout specifically states what we're using to fund that. And the challenge oftentimes is, and I say this, that the value of the business may be greater than the amount of insurance that we can fund in the plan. So there's got to be a methodology for the balance of the buyout. Maybe the insurance is the down payment, or maybe it's a stretch out for the balance of whatever the amount of the buyout is. But yeah, we've participated in those things.
Uh, what type of annuity are you using? Is it fixed, index, variable? Can you please elaborate?
In a fully insured plan, there's only one kind. It's got to be a fixed annuity, and it's got to be with a company that has approved their annuity to be included in a 412(e)(3) plan, and it's got to be approved in the state in which the client and the plan is going to be written. Okay. Now, Fortress Brokerage fortunately has a stable of top quality companies that have both first-rate life insurance and first-rate annuities that we can use. We can't mix and match life and annuity unless the life company we want to use doesn't have an approved annuity in the state in which the plan is going to be sold. And then we can mix and match an annuity that is approved for both the 412(e)(3) um, and the state in which you reside. We do that all the time because we, let's be honest. 412(e)(3s and traditional defined benefit plans were real big at one time with a lot of different insurance carriers. And because of legislation, a lot of carriers got out of the business, number one. Two, one of the biggest problems that we've had in our business is we have had bad actors who did things that cast a very, very negative eye on 412s and traditional DB plans to the tune that the IRS came in and started auditing every single plan. Now, thank heavens that period is passed. Okay. And we think we're down to doing plans the way the service likes them, except for our current environment in which our current administration is seeking revenue, and we don't know what they might do to things like cash balance plans. We're not worried about a fully insured plan. We're not worried about a traditional defined benefit pension plan. But when it comes to cash balance plans and 412(i) carve outs, then we have to be careful. You never know what's going to come out of Washington. We could go through another administration in a few years, and they may take the spotlight off of the qualified plan arena completely and get back to what we'd like to think are more sane times. But I've lived through a lot of that stuff. But the bad actors are the ones that cause the biggest problems. They try to do things that are not legit and convince people to do them, and then those people get in trouble. And that would be one thing. But it shines a bad light on all of us that do qualified plan business. Okay. Just because one guy doesn't mean that everybody else is doing it. And that's what happened the last time around. Just a few bad actors caused a challenge for the rest of us. I never had a plan disqualified ever, but I know a lot of people who did. Okay, I knew who the players were. They were good guys. They thought they had they thought they were doing what they thought their legal people said they could do. But the rest of us decided to stay inside of the 9 dots and use what we knew was tried and tested so that we weren't going to be subject to those things. And even then we got plans audited that turned up with no changes in the plans. So hopefully that's a partial answer. And before we leave, Ashley's going to give you my contact information so that if you have additional questions or want to call me, talk to me, more than happy to. I'd like you to make certain that you go through Fortress Brokerage. However, we've got a partnership here, and I want to keep them abreast of everything that's going on.
Thanks, Steve. That is all of the questions that we have today. You did get a lovely comment, very nice presentation, first class. So that's pretty nice.
It's always nice.
Uh,
And then the last thing I would say that if any of you would like to see a census or get a census for your client, we're more than happy. Ashley and Bradley are working on updating our census. But all you have to do is send us the census. When we get the census, we're going to send back to you a complete, probably on the phone talking to you to make sure I understand what it is you're trying to achieve before we complete the design. If it's a 412E3, your chances are Danielle Toth Paul, my daughter, is going to design it for you. If we get into cash balance plans, we're going to have one of our other associates design those plans for you. Whatever plan we design for you, with whomever we design it with, will be available to talk with you, your client's advisors, until everybody's satisfied that what you're doing is the right thing for your client and for you. And I'll send you out a letter of agreement so that we all know what you need to do for me and what I'll do for you and what it's going to cost you and what the fees your clients are going to have to pay. So just understand, we don't participate in the fees. The fees just go to our administrators who have to do all of the number crunching and put all the papers together. And the people that I work with are the same people that I have worked with for 20, 30, 20 or 30 years. Some of them used to work for me directly until we figured out that they were better off working in their own office and we were better off working in our own office. And with the advent of computers and voicemail and all the fancy gadgets we've got today, it allowed us to reduce the size of our office and staff, work more efficiently, and my daughter and I work very well together whenever she's not taking advantage of me. Because that's what daughters are supposed to do, I think. That's about it from my end, Ashley.
Wonderful. Thank you. We will certainly be sending out the census to y'all so that if there is a client that you have that you believe may match the profile of the type of folks that Steve was giving to you over today on this presentation, please do fill out the information, send it back to both Steve and I, and we will get our eyes on it. And like you said, we'll work together. You have the expert on your side to carry you through that type of sale and make you look like you're the expert alongside him. So just feel confident that you're working with the right folks here, okay?
You have my phone number. You have my phone number. You have our email address. Feel free to reach out.
Thank you. Thank you, Steve, so much for your time today. I really appreciate it.
Thank you, Ashley. Say hey to your dad and Brad for his back room assistance. We'd like to thank everybody that helps us be able to do these things.
Absolutely. And thank you so much for everybody who joined. Really appreciate y'all coming in. And if you have any additional questions you'd like to follow up with us, email us, give us a call. Happy to talk about it.
Thank you all.
Thanks.
Bye
Have
now.
a good day. Bye.